if you look at where spodumene is now, I don't think there's an asset on the planet that wouldn't make money at over $1,000 a ton.
And I'm again encouraged by the amount and the type of capital that is coming into this space now.
But I think cleaner and greener lithium should be the goal.
We constantly get asked, how quick can you get to market? Because this is more and more interest for the investment side of things.
Welcome viewers tuning in to this outlook on lithium. It's a webinar brought to you by Assay Live. As the participants filter in from around the world, I'll just give a little introduction to what we're doing, what we're going to be covering today, introduce my panel, and by then I think everyone will have been logged in and we can start our discussion. So we're going to be covering opportunities present in the lithium industry today. We're looking at investment ideas, all manner of issues impacting supply and demand outlook as well. I've got a selection of questions already submitted by registrants and viewers prior to the session, and I've collated those roughly into some broad themes that we can use to structure the discussion. Of course, if you do have additional questions or something that you want to comment on from what our panelists' feedback, then please type something into the Q&A session and we'll try and get towards that at the end. Now, if you're familiar with the lithium industry, you'll definitely be familiar with my panel of experts with me today. I'm very pleased to welcome Rodney Hooper, who's partner at RK Equity and co-anchor of the Lithium Rocks channel, Chris Berry, president of House Mountain Partners, Emily Hirsch, managing director at DCDB Group, and JP Varga de la Vega, managing director of Galan Lithium. So a warm welcome to everyone joining me from your various locations around the world, and thanks for taking time today. I'd like to start by framing the market at present. Let's first look at the supply and then the demand picture and then the potential impact on pricing from there. So lithium prices soared this year. It's certainly a great time to be having this webinar. Rodney, I wonder if you could kick us off with some thoughts on how you see a sustained higher price for lithium, whether you do see a sustained higher price for lithium, and then also what's your view on the supply side at the moment?
So thanks very much, first of all, for having me on. Yes, so I think the lithium market's been caught off guard in terms of how quickly demand has exceeded supply and gone through inventories that were sitting in the system. And now we find ourselves in a position where we are just come out of August and the price assessments for battery grade carbonate and hydroxide in China are over $20,000 a ton already, and we haven't even got to the higher demand period later on in the year. So, what's going to happen from here? It's very tight on the supply side. You're already seeing SQM pretty much producing at maximum, and I think going through some of the last of their inventory, and other companies trying to come online. The key thing now really to save it is spodumene, and that's in tight supply. Albemarle has stated that they would look to produce hydroxide using wodgina material and not sell spodumene on its own. But I guess the question is, if it keeps going at the rate that it is it worth selling some if you don't have that downstream processing capacity? So at the moment, I'm not sure what's going to fill the gap. I guess the only thing that could slow things down, is the chip shortage, possibly with some EV production coming offline. But it looks very difficult, and there's nothing on the horizon for some time. So there's no reason to see prices not rise further unless OEMs actively decide to take their foot off the accelerator, bad pun. But in Europe, you've got carbon emission penalties, so it's not optional. I think possibly in other locations, one could ease back on sales. But, as I say, we've just come out of August. Prices are already over $20,000 a ton. I can't see what's going to stop prices continuing upward.
Yeah, interesting. And there's talk of a perpetual deficit in lithium. Really, do you see a situation where we'll ever get back to a sort of a balance if you look at these EV projections?
I think lithium is a specialty chemical, but I mean, if I were to, the closest thing to a commodity, I guess, is spodumene concentrate, and I can't see that lithium, as the saying goes, for commodities, the cure for high prices is high prices, and the cure for low is low. If you look at where spodumene is now, I don't think there's an asset on the planet that wouldn't make money at over $1,000 a ton.
Yeah, Chris, please.
There's very little, I think, probably not just everybody on the panel, but everybody watching this today agrees that we're in probably the early stages of a pretty sustainable bull market for lithium chemicals. To Rodney's point, look, we all know how long it takes to bring not even greenfield, but brownfield assets on stream and get that product qualified and get it put into supply chains, which further downstream are under a lot of stress as well. I will say one of the things that I'm encouraged about in the current cycle relative to, say, 2015 to 2018 is that the type of capital that's coming into this space, and not just the amounts, but the type of capital is I was really struggling for the word, but it's much more sober and it's much more patient than it was, say, in 2015, 2016. I can remember talking to hedge funds in 2017 who, I got the whole song and dance about how, we have a 5-year vision on the EV thesis, and, all of a sudden the S&P falls 4% and you never hear from these guys again because they're worried about redemptions. And so, that's the game that the fast money plays. And I'm, again, encouraged by the amount and the type of capital that is coming into this space now. That's good. But again, to Rodney's point, what that doesn't solve is the time that it takes to bring these assets on stream. To your question about perpetual deficits, I'm pretty nervous about jumping on that ship, so to speak. I think anytime you have a business, whether or not it's commodities or specialty chemicals, and you've got 30% margins in a business that's growing at 20% a year, and I think my personal view is I think lithium demand grows at 20% a year out to 2030, that's going to attract a lot of competition. It's going to attract a lot of eyeballs. And, the risk of an oversupply situation that we had in, say, 2018, 2019, 2020, I think is diminished today relative to what it was, but it's certainly not zero. So, there are some potential bumps on the horizon there.
Yeah, absolutely. It's a tricky landscape, but good to be in the bull market. Emily, what's your view?
I agree with most of what Chris said, and I think that the type of capital is not just sober and patient, but it's also stickier, as in it's committed to and more capable of taking on these long time frames from getting a project qualified. One of the big changes as well that I think is comparing this boom to the last boom is that last time it was really a question of the mining money didn't understand the lithium business and the chemical money didn't understand the mining business, and where those two thought processes needed to meet in order to get the right kind of capital to the right kind of lithium projects was absent. Whereas now I think the expertise within the lithium space in general is not limited to, a handful of folks who happen to be the ones who had that experience. I think that mining groups and mining money have learned a lot more about the fact that, maybe just selling spodumene is not the best business to be in, maybe understanding that there is a big value add between it when it comes out of the ground and when it's ready to go into a battery. And then likewise, I think that the OEMs and the automakers have hopefully learned some valuable lessons in that they can't just sit and wait and expect for the product to be there when they need it. That being said, I do think that not so much looking at sort of supply demand issues, but if I had to say in the next 10 years, will there be periods of oversupply? Will there be periods of scarce times? I think that that's a reasonable and expectable thing to happen, because I do think that we're in an environment where things are sort of slugging and then sprinting and then slugging and then sprinting. And a lot of supply chain shortages for other things, like the chip shortage, for example, or maybe something that none of us are thinking about, have the ability to impact the parts of the supply chain that maybe in the past we haven't linked to the cars or the batteries.
Yep.
So I'm not sleeping easy about anything except that it's a good lithium market, but there's enough other stuff out there to keep my anxiety.
Yeah, it's a fair point, and that leads me to the question then: are we all in agreement around EV penetration rates, for instance? Sorry, I just lost you there, Rodney. I just asked. This leads to my question: are we all in agreement around existing EV penetration rates? If we're going to see this supply tightness really coming on, and you chuck into the mix all the other supply chain issues around semiconductors, as you raised, Chris, Emily. Is everyone now scrambling to revise their forecasts of xEVs by the end of by 2030, for instance?
I mean, in a way, I'll just jump in there briefly. 2030, in some ways, is a long ways away, and when you think about automotive cycles, it's really not.
Yeah.
Sorry, I think Rodney's frozen there. All I'll say, and then I'll just step back. Maybe JP, you can jump in. But I have long maintained that if we get to a 10% EV penetration rate by 2025, that is a slam dunk home run, touchdown. You pick your sports analogy. Maybe there's something for cricket for you guys in Australia or South Africa. Sure. And it all comes down to raw material availability, but not just the ability of the producers existing and near term to produce material on spec, when you also have this sort of moving target of battery chemistries that continue to evolve as well. So that's all I'll say. I think 10% EV penetration rate in the next 5 years, which in some ways we're not that far away from right now. I think last year penetration was 3.8% or something like that. So we're close, but I think it's a big leap to get to that 10%. Ultimately, though, we're, again, 2030 is just a long ways away.
Yeah, of new vehicle sales, I think it's doing particularly well. JP, go on.
Yep. No, it's at a high level view for where we're facing. It's like we've seen what happened 100 years ago when the horses got retired for the combustion engine. Now the combustion engine is going to be within the next 10, 15 years, maybe retired. The market penetration of new technology is being seen time and time again, mobile phones, and there are many examples of that. What we've seen is unprecedented in a way in terms of mining. I mean, as Emily was saying, there is a market and we're going to go up and down. We're going to see outbursts of supply here and there. But when you look at the companies that can today respond, they've got that limitation in what they can do. Then when you start asking yourself, where all of the rest of the lithium is going to come. So you can see at a macro level, Argentina still got projects that can produce more. Forget about Chile, it's not bringing any more than what Albemarle and SQM are allowed to. Even though Chile's got a fantastic endowment of salt flats. Well, I'm originally from Chile and I'm developing an Argentine project. So that answers the question. Now, it's not coming more from Chile from those two companies. Bolivia, highly likely. And then what are you left with in terms of large production is spodumene. And that is, Australia is being really now, it's been quite busy on the lithium exploration for spodumene and may give some answer to that, but the rest is Africa. If you could do an analogy, this is in terms of nickel. You got nickel sulfides that is like around 20% of the total endowment, and that's an easy thing to process and concentrate and sell. And then you go a nickel laterite that is 80% of the endowment. I would say nickel laterite could be similar to what is lithium spodumene. So, but at the end of the day, what we're seeing is in a bit unprecedented. We're talking about batteries. Lithium, that's the main market. And also, as we are developing, the market is adapting more batteries, things that we never thought of. And so it's not only vehicles, it's just everywhere. So as we're trying to be less dependent on the grid, there's more to come. And and potentially part of the demand is not even being accounted for. So this is it's a big problem to have as a lithium explorer and developer. It's not a big problem to have if you are a battery maker, and that's the disconnection that it's been addressed before by Emily and Chris and Rodney. That it's this is definitely a market that it could be done a bit too little, too late. You know, everyone was screaming and shouting and said, "Look, this is what's happening," and now it's coming. So this that's what I see in terms of the market terms.
Interesting. It's great, JP. Tell us a bit about Galan. You've got 3 million tons of reserves in the ground in Argentina. As you mentioned, Argentina's where you believe it's happening in LATAM. But do you think the capital is becoming more patient and more knowledgeable and a little bit more integrated, I suppose, across the supply chain, as Chris and Emily were highlighting? That's what's different about this particular ball run to the last one.
Correct. I agree that there is more money around. I mean, the liquidity of COVID as well, has helped into all this cash injection has to go somewhere. Now, from our end, we raised 50 million Australian dollars a couple of weeks ago, and we were way oversubscribed, and that was a nice thing to see, because a year earlier we were doing a similar exercise, and the market attention wasn't there. But one of the things that I could see on this round is that funds are quite doing the homework. They're looking at what we have, what it is. We are at the Hombre Muerto salt flat that equates to Livent. It's been there for 28 years. Bosco bought from Galaxy at the time half of Sal de Vida, and now you go Galaxy that merged with Orocobre. It's Orocobre today, making them the fifth largest, if I'm not wrong, the fifth largest lithium producer today. We're in a very hot part of Argentina and the world, and we have 3 million tons of lithium carbonate equivalent with high grade. And the money that we raised had a lot of questions coming from the investors, because they wanted to know what we have, how can you get to market, and we constantly get asked, how quick can you get to market? Because this is more and more interest for the investment side of things, and also everyone is in lithium, so there's a retail push on the other end. It's a strong interest on wanting to build lithium. We would like to be a producer, and then we're taking our project, our largest project, Hombre Muerto West, into a definitive feasibility study, or DFS. And yeah, it's been a total turnaround from what we saw the last year, that we scratched the barrel to fund a scoping study, or PEA, to this time around. The money was almost not thrown, but smart money came in our way, and they understood our thesis, and I'm really pleased to see that at least now there's funding coming forward, and I think that's across the board, because the same week that we did the race, there were quite a few other races in the Australian Stock Exchange that were back in lithium, also future developers.
Excellent. While we're on that, then around looking at the performance of the market, and then also looking at equities, how equities often follow prices. I believe, Rodney, you said, what's the approach from the panel with regards to making sense of how the juniors are performing and where you're advising investments go? Is it a case that all ships have risen off the back of a great price? Who's doing well? We don't want necessarily individual stock picks, but how selective do you have to be as an investor looking at the junior tier of the market right now? Rodney, do you want to take that?
Yeah, I mean, that's a good question. My saying is always, even a turkey can fly in a hurricane. So you've seen a lot of things go up substantially, and some of the top performing names of companies I didn't really have on my radar. So, the question always, and I'm sure, it'll be interesting to hear from the others. I'm pretty sure Chris would agree, is it's one thing to have your share price rise and raise money. It's another to be permitted, constructed, in production and qualified, and earning the prices that you're seeing today. And so at the moment, literally everything stacks up at over $20,000 a ton. Every project pretty much makes sense, even the sort of low grade. But is 20,000 a long-term sustainable price? That's a debate. So I think if you're buying, shares to sell on to somebody else because prices could go higher, that's one thing. If you're in for the long haul, that's another. I don't see China building its a clean energy platform on $20,000 a ton carbonate. That's just not what I see. Or hydroxide for that matter. So, I think that if you're going to stick in for the long haul, you need to look far more at the fundamentals. If you want to do it short term, you can get away with anything because I think lithium prices are going to go up further.
Interesting. Chris, what's your take? And is this 20K the incentive price?
I wouldn't say, Rodney's right. It's a huge debate, right? I think that, again, during the last cycle, I think prices peaked at maybe $20,000 carbonate and $24,000 hydroxide, if I'm not mistaken. And then, it was sort of downhill from there. Again, I just think that things have happened pretty quickly in the last year, but it does seem like we have further to go. This presents a real problem for investors, right? Because when you take that $20,000 carbonate number and lay it over the existing cost curve, even the cost curve for lithium out to 2025, literally every project in the world today is pretty soundly economic. Even some of the garbage hard rock assets in China that are way, way out on the cost curve. But nevertheless, I agree with Rodney. I would not be thinking that we're going to settle in at $20,000 or $24,000 a ton. I think, every investor needs to look themselves in the mirror and just sort of say, okay, what do I think the break-even price is? Where can I go to sleep at night? So, for example, if lithium pricing settles in over the next few years, say at a blended price of $12,000 to $13,000 a ton, that's personally where I think things are going to reside going forward. I think that allows really good, and let's just say next tier projects, maybe, some of those spodumene assets that are around 1% grade to get financed and built. You can make money on those types of projects and get about a 15% IRR at about $12,000 to $13,000 blended lithium pricing. So, I don't want to paint this scenario necessarily that we're at this peak and we've got further to fall and so on and so forth. But I would not be planning for, say, $20,000, $25,000, $30,000 lithium. Ultimately, that is going to affect battery economics, and it's going to give investors and downstream players pause in terms of how and when they invest. So I think, again, I haven't really changed my stripes. I've always said, $12,000 to $13,000 lithium is where we're going to reside. And when you kind of scan the horizon and look at almost any feasibility study out there for near-term production, I mean, they're all planning for a $12,000 or $13,000 lithium in their economics. We can argue about the discount rates at 8%. Maybe that's a little bit low, maybe not, depending upon, the cost of capital globally. But nevertheless, again, it's an interesting time in the lithium space because I do think we've got further to go to the upside. But ultimately, I think pricing settles down in kind of a lower range.
JP, just out of interest, what's the economic viability of your project? What price range do you look at when you run your scenarios?
Yeah, well, Chris is mentioning $13,000 a ton as a long-term price, and to us, when we did our first economic study, and that's very optimistic because we did it with $11,500 an hour. Right. And that was last year. So, and we had, with that metric, we have a scoping, a PEA with 20,000 tons of lithium carbonate production for around 40 years, with an NPV of $1 billion pre-tax, operating cost of $3,500 a ton. So when you look at that, if the price has gone to 13, even 14, that for us is even better. But we have a strong, robust project, but it's not coincidence what we're seeing, because look at what Galaxy did. They released their own feasibility study, NR43-101, with very similar costing. And if you look at Livent, the operating costs are similar, even though they use a different type of technology. But they're all about that sort of range. And where do we see that this is going to go? It's anyone guesses. But if you are in the low cost of the cost curve, you could even, if you get it right, you can get a payback of around 2 years of on an investment if you can, hit it, which is it's something very interesting to contemplate, that we could be down the track into that level. Having said that, one of the things that we're trying to focus is we would like to walk before we run. We understand that from our end, to produce lithium carbonate, it's a big ask. We look at the likes of Orocobre and the technical challenge that they face. We like to see if we can produce lithium chloride concentrate to start with before we can get into lithium carbonate. And also we identify the technology may change down the track, because if you start looking at solid state batteries, or something that Emily is doing, production of solid state batteries coming from chloride goes straight to metal. So you don't need a carbonate, you don't need a hydroxide. So who knows where the market is going to be in 2-3 years, or 3 years when we like to be on coming online. But and also, if we can produce concentrate, it's less of a pressure for us to qualify our production. We don't have to qualify lithium carbonate standards, and we don't have to have an offtake with X, Y, and Z. So for us, the economics are there. We're trying to use our funds smartly. We like to get to market as soon as we can, because we recognize the importance of reducing project risk. We like to sink our capex and trying to minimize the chemical exercise that lithium comes, because at least on the brine side, to produce lithium carbonate is not, I wouldn't say it's a done deal. So it takes a while to fine tune. And so we want to walk. We're happy to apply the Australian model, which is, you get your concentrate and then you export that. And then in parallel, we still can do all the testing that we need to do to become a carbonate producer. So in a nutshell, our approach is conservative. We like to see how can we do things the best way possible. But compared to where we were a year ago, things are looking quite bright, and we're pleased to see the market has completely changed.
Excellent. Very good. Well, I want to keep just on the mining and chemical extraction techniques part, just for one more question. And then I'm going to move on to another segment that the audience is asking a lot around batteries, OEMs, supply chains, and chemistries there. But sticking with while we're talking about extracting lithium, I've had a couple of questions around the cost side of processing hard rock lithium compared to salars. Now, I know this is going to be specific to the projects, but is there a general consensus or a feeling that one is more costly than the others, one has greater speed than the others, and then of course one has greater quality of the end product? Just put that to the panel for a sort of entry-level question.
I think that from a cost standpoint, you can get to general rules of thumb. If you're starting with hard rock, you have more flexibility to go hydroxide or carbonate. Whereas when you're starting with a brine, the process by which you'd go to hydroxide, if that's what you wanted to make, would go through a carbonate essentially. But we're seeing a lot of new flow sheets and a lot of technology that does question some of those rules of thumb. But I think it's also important to introduce there, in addition to looking at the cost curve, looking at sort of the carbon curve, right? So which of these products is going to produce lithium chemicals with a higher carbon footprint? Because I do think that both of those curves are going to start to be right next to each other in reports on what's the more advantageous project. And I do think that brines have a very strong, especially brines that are using direct lithium extraction techniques or not using as much soda ash to see where that cost comes from. The brines have a lower carbon footprint than the current spodumene supply chain.
Yep, that's a very good point around, not thinking this on a pure cost basis, but include that carbon cost curve as well.
I believe the carbon cost curve is going to become a cost curve to some players in the market.
Yep, certainly. Okay. Unless anyone else has got some comments on costs or costs around extraction, I wanted to move on to direct lithium extraction techniques. I had a question around the timeline for scaling up DLE, and if anyone has any comments on that.
Maybe just to jump in really briefly, I think that, you know, one of the challenges with ESG is, how do you define it? Okay, are we all going to use the United Nations principles or whatever they're called? I mean, that seems like the best way to go. Companies like, I think, BlackRock are starting to better define what they expect their investments to adhere to. I think there's some concern, you know, given the lack of clarity around how you define ESG, the E, the S, and the G. You know, what does that mean for costs? I talked to an investor earlier this week that says because of ESG mandates and criteria, she adds 20% to any costs that she sees overall in any sort of a feasibility study. Now, that's a big paintbrush sort of swipe at the industry, right? I mean, that's not very well defined, but it does give, I think, us an idea of how people are thinking about ESG and those associated costs. You know, obviously on the brine side, and JP, you know this probably better than anybody here, your reagents are a huge component of the OpEx. And my understanding is on the DLE side that your reagents can be 65 to 70 to 75% of that OpEx. And so, you know, there are certain benefits to DLE, you know, no ponds, faster to production, et cetera, et cetera. We all know the sales points, but, you know, it does come at an additional cost, I think, in some instances. And that's one of the things that I think the industry is really struggling with right now. To Emily's point, you know, hard rock versus hydroxide, these are the types of things that you need to think about if we are going to embark on this sort of focus on ESG and whatever you want to call it, green lithium or clean lithium. Again, it's a huge challenge.
I would like to call, you know, just, I think that it is a challenge, and I don't propose a perfect solution, but I think cleaner and greener lithium should be the goal, because you can take any object and go all the way back to its supply chain, go all the way back to its roots, and find, you know, little things that are not perfect. We don't live in a perfect world. And then you can get into debating the minutia of what is ESG, what gets a stamp, what doesn't get a stamp. But it is equally easy to say, you know, here is one project A and here is project B, and you can make comparisons between those two projects and decide in that. And so looking at a clean and ESG curve or a clean energy curve, and then making sure we all agree on, you know, what impacts, what footprints have to be used. There was a great article, I think just yesterday, on the soda ash and the methane that's caused by extraction of soda ash. That's, you know, soda ash is one of those main cost contributors to your conventional brine extraction. So is the soda ash counted from the ground, or is it counted when it goes in? And then am I counting that when I say, okay, hard rock is usually less green than a brine? It really is cleaner or greener versus what's clean and what's not.
And I think, go ahead, JP.
Sorry. No, it's interesting. When you look at lithium brine projects, for instance, Galan at this stage has decided to go use the conventional way of evaporation. And why is that? Is because we're in the middle of nowhere and access to energy is scarce. You know, we're not close to power lines. We're not. We are close to a gas pipeline, but then if you're going to use a DLE solution, is highly energy intensive. So if that's going to be from gas, then you have the question, well, I'm using CO2 from the gas to produce energy and so on. So the solution is horses for courses, I will say, in terms of how you face which decision you're going to go in terms of the avenue of your product and the pros and cons. For instance, we don't have access to energy, so that's why we're trying to use the best we have, which is high radiation from the sun, 4,000 meters. and that's what we, to us makes sense, because no access to energy. And if we would like to be lithium concentrate producers, then we don't have to produce lithium carbonate, hence no solar ash from our end. And we leave that to the companies that are really good at it. So we definitely we are starting our ESG estimate, because there are standards that can be done. And I think that and I agree with Emily that while nothing's perfect, but the world wants to have these answers, and things will standardize at some point. The investments are maybe skew at some level for some answers they're going to get. But if we're having this conversation in 10, 20 years time about the ESG in mining, we're probably going to have more of a standardized version of how to account for CO2 footprint and where we're going to go. And we need a starting point. And could that lead to people making the wrong financial decision? Potentially, we don't know. But I think that we need to get into that, identify what is our carbon footprint, and beyond that, as a company, from our end, is like what else can we do to minimize a carbon footprint, with ideas about, like, for instance, where we're going to get the energy from, or if we're using diesel, how can we minimize the use of diesel by all means, and so on. So it's a really interesting starting point on the industry, and I agree that we are moving in a different way, and standardization down the track will come down. In my view, sooner or later. I understand that there are complexities with that.
Yeah.
I'd throw one thing in, Adam, that is a bit of a flag for me, and I've seen it, is, when companies, they don't just look at lithium, they look at their entire footprint across, the entire production line, and then you have a thing called net carbon. People talk about net carbon as a number, and there's some quite creative ways, shall we say, where people use carbon offsets to come to where they want to. So there's another little twist in the tail here, where where there are low cost ways of, to my mind, getting to net zero that don't look legit. So, or let's say at the very least creative. So it's going to evolve. I think Emily's identified it's right. It's unavoidable, but how we get there, and OEMs don't have the margins to pay up right now, so they don't. And carbon border adjustment mechanisms and all those good things aren't in place yet, but they will come, and that day of reckoning will come. It's just not right now.
Yeah. Yeah, certainly an evolving landscape, but one that's changing daily. That leads to the question around sort of price impact on sustainability of the end product, or maybe premiums on end products. And I know we've raised this before, but I'd just like to put it back to the panel. Are we going to see more of a variety of prices depending on the end product, according to where it's come from, how it's been sourced, but then also price premiums, basically, depending on whether this is ex-China supply, it's not traveled so far, etc.
I think more quickly than that, we'll see, to JP's point, we'll see a wider variety of lithium chemicals on the market, especially as battery chemistries evolve and different pieces of the process gravitate towards where the ecosystem exists to support that part of the process. I wouldn't be so bold as to predict, this chemical's this place, but I do think that as the, innovation within the battery and the desire from the battery folks side to respond to other market pressures, to build better batteries in terms of how long they last, to build batteries that are easier to recycle, to build batteries. I think lithium ion for stationary storage is preposterous, but that could also happen, right? But there's so much happening in terms of not just electrify vehicles, but electrify everything. And so I think that wider range of what is a sellable product or not is going to evolve more quickly than a variety of pricing. When it comes to will you get essentially a premium for having a greener project, I think that premium will come at your cost of capital, not at the end sale. I think that folks who are able to demonstrate an environmentally sustainable, but I think there's a better science word for that, process will be able to raise capital at better rates than those who aren't. And then when it comes to the US or the EU supply chain, I mean, I do find it troubling that, you know, China and Ganfeng, and good on them, right? I think they're doing a good job. But it makes me kind of feel like a lot of my words and the words of people like this panel are going on deaf ears when you see basically one Chinese company with checkbook walking around Argentina, you know, taking out, you know, I had a list 10 years of projects, or 5 years ago, of projects that were interesting. And a good 80% of those are now in the hands of one Chinese company. So that happened. So I think that, yeah, when it comes to pricing premiums, I think that that's going to show up on the cost of capital side, not on the final price side. And I think that I don't know how the desire for local markets or sort of, you know, nationalistic preferences will drive product to one market or another in a way that cost doesn't.
Yep. Okay. Well, before we delve more into battery chemistries then, and then product and supply chains, I just want to pick out what you're talking about around Ganfeng and also the M&A question that we touched on right at the beginning. Yeah, no, I think it's a good point there. You know, are we going to see more M&A in the lithium space? Is the price is probably a bit too hot?
JP, are you going to sell to Ganfeng tomorrow?
We are a listed company. We are open to the world, so we don't have a preference from our end, as long as it makes commercial sense. But this is we'll try to get it online first before selling. You know, that's from our end, our view, because we have something unique, and as such, we'll try to hold as long as we can, and it makes commercial sense for us to do so.
Adam, I mean, interesting what you said there. If you look at the price that Ganfeng paid for its stake in Goulamina from Firefench, and you look at the Piedmont transactions into Sayona and into Iron Ridge Resources, their Ghana assets. I mean, granted they weren't done this week, but they managed to get those at sort of price to NPVs of 0.25, and then you had the Millennial transaction as well. So I guess typically you'll see that for the major players or potentially outside investors stepping in, I think if they see the potential for a phase 2 or phase 3 on large assets with a lot of scope in the future, I see JP nodding because he's got lots of tonnage, that's where they see a lot of potential. And if you can probably be a little bit more generous in your pricing of the phase 1 project and where you pay a price to NPV if you see expansion potential and a decent long life asset. So I think M&A is if you look at where things are at, and given the shortage or what have you, I would say advancing assets that have got a good chance of permitting, and on the spodumene side, you know, the DMS only, because you can put limited capital and get that into production. People forget, I know it's gone now, but Tawana, Elita, whatever you want to call it, was up and running in 9 months on 70 million, and some of the others. So those type of assets will be, I think, in continued demand. And on the brown side, you know, large tonnage, long life potential will also have, you know, people will be interested.
Okay.
And you saw that, you know, the merger of Galaxy and Orocobre, you know, 2 years started this company that just got together, and that's something a bit of left field. I wasn't expecting that. Who knows what else is going to come out as, you know, time passes, and the C companies with good assets that make sense for them to not only from the acquisition but the mergers of other companies.
The only thing I would add here is just further downstream, I mean, General Motors, Stellantis, Daimler, I mean, they're talking about spending, I think, collectively $110 billion on their EV and AV platforms just in the next 5 years. I think Daimler might be out to 2030. But, first of all, I'm interested to see how all of that capital gets allocated efficiently and in time, and where it's allocated. I mean, obviously, you sort of say, well, gee, security of supply is the main issue here. So why aren't these major players going directly to the mines? And I think that the General Motors and Controlled Thermal Resources deal is an interesting one to keep an eye on. Again, there wasn't a heck of a lot of clarity, at least from my perspective, on what the investment looks like and how it's going to be allocated. I think General Motors talked about in the press release a multi-million-dollar investment, but a multi-million can mean 2 million or it can mean 200 million. So there's a wide sort of disparity there, I think, in terms of how that one rolls out. But again, it's another instance of not so much M&A, but I think folks downstream thinking hard about the security of supply issues. So I think, I don't know if the General Motors deal is a template. It's certainly a case study going forward, because I think there's a lot that we need to understand about it. But, it's an interesting example of downstream investment.
Certainly. That brings to my question around the supply chains, and moving on to that area, and we've sort of touched on it and answered within other questions, really. But how at risk are the various parts of the supply chain? The OEMs, are they sweating right now? I think security of supply, as you say, Chris, is the big issue. CATL, investing in more projects. The battery cell manufacturers seem to be keen to put capital into mining companies. We're going to see more of it. Is that likely?
I think that I think it is more likely, but only because more time has gone by and there's just more. But I do think that I've always found it to be very interesting when I get to talk to somebody who analyzes just sort of the OEMs and just their decisions, because for me, lithium supply and then the battery supply chain is the most important thing that I think about every day. I wake up, I think about lithium, I go look for lithium, I work on lithium. This is me, this is what I do. Whereas the OEMs have, and rightly so, a number of areas that are crocodiles closer to the canoe. I guess when you look at what are the biggest problems that OEMs face, lithium supply is a problem and a real problem, but it is probably not as big a problem as even within the battery. I think cobalt scarcity is a bigger long-term problem, and nickel scarcity is another long-term problem. And so I try to not be too hostile or judgmental that maybe it'll take them another year or two to get their acts together and get the right knowledge together and the right sort of in-house expertise together to be making smart decisions when it comes to a space that's outside of their specific area of expertise.
Are there threats to lithium demand? Everyone believes the demand story, but think about alternative chemistries or the sodium-ion batteries that have been talked up quite a lot from CATL, or lithium, not using lithium-ion batteries for every electrification use, for instance, finding substitute.
I think anybody who's looking at lithium should, or I would take out their forecasts that are related to stationary. I don't think lithium ion makes sense for stationary, and that doesn't mean I'm shilling for a different chemistry, but a lot of the challenges of keeping the battery happy with how a battery behaves over time, and those challenges are worthwhile in an application where range is a major consideration, where energy density is your number one consideration. Whereas if you're talking about a stationary application, you aren't speaking in that space. And I think that I think I could take it or leave it, I guess, when I look at lithium. But when it comes to applications for mobility, and especially anything outside of very heavy trucking or very heavy power applications, we're going to see, in my opinion, lithium ion and innovations within lithium ion to make the lithium ion better battery. And then we'll eventually get to a chemistry that uses lithium metal. And other applications or other chemistries that are going to continue to develop, or they all have a time frame to come out of a lab and get piloted and be seen at scale, and that. So they won't come out of left field. You'll have about a 5-year lead time to understand them, and then B, these are going to be batteries that are innovating for a different problem than mobility solutions.
Adam, yeah, I agree with Emily on the stationary storage, and I think the reality is lithium ion can get the job done. That was the beauty of lithium ion. It has incredible potential, but I guess given the scarcity and costs, we're going to see a shift. And I think I would agree on the ESS side, and there's also Chris can talk to vanadium and so on, but you've got and I think then what we're seeing, something we haven't discussed because it took us enough years and exhaustion to get the EV thematic believed, and now it's there. I would say post 2025, in my opinion, if you're going to make major inroads into GHG emission cuts, aviation is the next thing on the horizon, and that's going to need very specific and high performance batteries that I think the future generations of lithium ion. So I think you might even see LFP make more inroads into the EV, out of ESS into EV, and then high nickel and specific where weight and energy density are absolutely critical. You'll see that for aviation. But if something's too expensive and the economics don't work, people will always look to thrift. We've seen that. Everyone goes on about the ESG of cobalt, but they don't talk about the truth of the $100,000 a ton it was trading at the time. That also saw it, get shipped out the door. So I think, it makes sense if we're going to move towards a clean energy world that we do see alternative chemistries replacing in some areas, because there isn't going to be enough. If we're going to, I've said before, if you can get kilowatt hour at the pack level down to $60 to $75, you're going to electrify everything.
Yeah, I would. I mean, again, just trying to think of some different things to say here. I've never been bullish on second life for lithium ion. A lot of people forget that you're going to be dealing with a used cell, a used pack. Maybe it has 70, 80% of its useful life left over, which is a lot, but there is a cost to dismantling and then reconfiguring that pack and that cell for long duration energy storage. Lithium, again, we've talked about this a lot on these panels, that has a 30-year head start on a lot of other chemistries, maybe not quite that long, but you compare it sort of long term on something like vanadium redox. And yes, Rodney, you and I have talked about this a lot in the past. I mean, vanadium redox is a much better solution for long duration energy storage, say 4 hours plus. It's infinitely recyclable. Yes, it does not quite have the energy density that lithium ion does, but it's a much more realistic, I would argue, long-term duration energy storage solution. So, as the market evolves, I think, again, sort of agree with Emily. I think mobility, it's really going to be very hard to beat lithium ion, whether or not it's solid state or LFP or, lithium sulfur, whatever the market evolves to. I don't think there's going to be an all one size fits all approach, but I do think you're going to see a lot of growth in these alternative chemistries like vanadium redox. But then again, it does become a question of where does the vanadium come from? It's primarily used in steel. It comes from South Africa. It comes from Russia. It comes from China. So there are some geopolitical challenges there, potentially. And of course, the vanadium in that battery can be upwards of 30 to 40% of the overall cost of the battery. So you got to find cheap, high quality material. So I know we're here to talk about lithium today. I'll get off the vanadium soapbox, but just to illustrate the point that there are competing chemistries out there that actually, I think, are viable long-term solutions.
Yep, definitely. No, it's a very valid point, and we had a few questions around that. You know, what are the competitors out there? That's great. That touched on it well. We've had a few questions around some regional projects in different regions. Someone's asked about Namibia, so I wonder if anyone could just comment. I think JP, you mentioned about Africa actually having a little bit of, you know, potential there. What are the regions within sub-Saharan Africa, I suppose, that has potential for lithium, and how far away are these projects from becoming quite significant in terms of the global supply?
Well, if you're looking at the economics of any mining project, if spodumene is bulkier than producing lithium brine carbonate, you know, the tonnage is very different. So if you're assuming that you're going to be producing a concentrate of around 5 to 6% lithium spodumene, I mean, you may be maybe higher than that, but it's still bulky. So you wouldn't like to be to more than 700 kilometers if you've got access to rail. So any coastline project will work, and an example of that is Australia. You know, most of production from spodumene is pretty much close to the coast. And so now in terms of where in Africa, you know, just to start looking at what companies are already exploring in different part of the southern part of the African continent and some on the western part. Look, you can find spodumene as well in Argentina. You know, you can find spodumene in Brazil. You know, there is there, but at the same time, is it economic? You know, if you give me a long-term price of $2,000 a ton for spodumene, definitely a lot of spodumene could come from many countries, and but it all comes down to what price assumption do you want to, you know, assume, and then, but a rule of thumb, you know, just look for projects that are, because it's bulky, close to infrastructure, roads, or close to rail, and they got access to port, and can sort of support that sort of bulky industry. Otherwise, it's, if you're going to do it yourself, then everything starts scaling up and the CapEx just blows. So it's
Adam, where I'm a big fan, I think is Canada. I think Canada's spodumene, in terms of cleanness and low impurities, it's a mining friendly country. Quebec is keen, and it's got low cost and clean hydropower. So I think they could substantially lower the carbon footprint of spodumene derived chemicals. But you know, JP, everything comes with its quirks and its challenges, but I think in terms of quality and keenness and staff, you know, labor and energy, but the reality always, I guess, comes back to you need it all, you know, and that's why I said about, you know, with big projects, and that's going to be, you know, positive for JP's project and others, is when you've got big resources. And again, it's not just the economics. If guys are going to go through the hassle, they want the scale as well, you know, because it does take time to set up these things, and sometimes it's new infrastructure, so it has to be significant in order to make the effort.
And I think I think again, I think if we could get put on a t-shirt, JP's you know, bulky stuff needs infrastructure, it's sort of the biggest takeaway, I think, to take a look at. And not only the, you know, we haven't talked about sediments on this, you know, we've really looked at hard rock versus brine, but there's a reality that there's a lot of sediment-based lithium projects around the world, a lot of focus on Nevada. And in order for, or from a very, you know, rising tide rises all boats, all of those projects will benefit from better infrastructure. And the same is true to projects. You know, again, JP has sort of hit another important head on the nail when he's talking about, why am I doing a conventional process? Because I'm in the middle of nowhere and I'm at a high elevation, and it's stupid to burn stuff at altitude, right? There are some realities that are project specific, and if you're into very early stage exploration, going out and getting together some of these assets in places that don't have great infrastructure, but are likely to have better infrastructure in the future is a very decent mindset or a move to take, because it's very unusual that a project alone, even if it's one of the biggest or best deposits, will justify and want to build by itself all of the road and all of the rail and all of the energy infrastructure that that project is going to need. So not only looking at sort of political risk at countries, but also having an understanding of, if you're going to go into a jurisdiction where this type of infrastructure needs to come online over 5 to 10 years to make this project work, understanding if, making a judgment call on, is this country sufficiently capitalized, serious enough to make those infrastructure investments, or is there a way to develop a relationship early on with a development finance institute, a World Bank type of a player whose job is to come in and build heavy infrastructure? Because as a mining company, that's probably not going to make your shareholders jump for joy if you come out and say, I'm going to build a train.
Certainly. Look, we've come to the end of time, but we'll have one more question if we can race through it that a few people had submitted in advance, and then also one that's come in now. It was around Europe, actually, and then also looking at European projects. I know no one, Rodney, you're currently here, but not everyone's based here, but Rio Tinto and the Jadar projects being one of note, but then also this notion that, intrastate backing of projects as these materials become more and more critical to industry and greening our societies. Europe's got a clear agenda to try and onboard, or certainly develop a lot more of specialist transition metals, including lithium, domestically. How does everyone see that playing out, and sort of bringing kudos to projects that have that kind of support on a national level?
I think it's hard to compare Jadar to other projects simply because A, it's owned by someone who could build a train, so in a category of itself there, and then B, I don't remember off the top of my head, but it's something like 10 to 1 or 7 to 1 units boron have to be sold for each unit lithium. And so Rio Tinto is uniquely positioned to be able to understand not just the supply and demand of boric acid, but they have teams of people dedicated to understanding those logistics. I think the question, will they jump on, and flood the market with lithium? You can really understand what's going to limit that project's production based on how much boron Rio Tinto would be willing to sell as an intelligent business decision. And so I love that project, but I also think it doesn't bear many similarities to other projects out there, both because of the composition of the ore and also because of the capabilities of the team.
Yeah, excellent.
I think, Adam, that they, I'll risk the video, they put it to a national vote, which to me is the kiss of death. Whenever you do that, then you're always it's going to be like a lightning rod to everyone who's going to not want that project. I think even if they clear that thing, I don't think they're talking about full scale nameplate by 2029. I would say 2030 is I don't think this decade it'll produce. I still, there's still feasibility, and Emily raised, the right point. It's also boron driven, but I think in terms of putting it to a national vote, you're going to attract negative attention the whole time. So we'll see. It's a tougher, and it also falls outside the EU. So
yes, indeed, true.
So I don't know how that sort of plays out. It's not known mining jurisdiction. So and I think I stand corrected, Emily. I think it was like 23,000 tons of lithium is like full nameplate or something.
I think that you're correct, but I think that I've never even gotten to looking at that portion as the tipping point, because for me the way that has to balance with the boron production has always been, I think nameplate will be what the boric acid market will sustain. I think it isn't determined as much by the lithium as it is by the boron. I could be wrong. It's an opinion.
Indeed, no, it's good to get opinions on that.
You know, the only thing I would add, just very briefly, I know we're running long here, but so obviously pushback on Jadar. There's been a fair amount of pushback in countries like Portugal to bringing hard rock assets on stream as well. So this is not just something that's on the periphery of the EU. You know, I am encouraged by the European Battery Alliance and a lot of the things that they're saying and focusing on. I think the really important part of the supply chain here is the lithium conversion, or just let's just say the chemical conversion in general. I mean, we all know getting the mine built and up and running is a Herculean task, but I think that, you know, it would probably benefit the EU and the EU automotive industry, which clearly is going to compete with China for EU sales dominance, to think hard about that middle kind of midstream portion of the supply chain. I think that's really, really important.
Yeah, excellent point. Yeah, the EU sort of caught with its principles on environmental standards versus onboarding and developing more industrial capacity. Okay, excellent. Well, look, we've shot over time a little bit, but we've covered some really good ground, and it's been great. So I say thank you very much to my panelists again for joining at various times and giving your expertise over this hour. And we'll be doing more of this down the line. So thanks everyone for tuning in, and look out for more Assay Live webinars coming up. Thanks everyone.
Thanks, guys.
Have a great day.
Cheers.